I think we were all anticipating that this was going to occur. We saw 6.8% down month over month. And that was largely driven by the single family sector, which is down about 14%. We're out there working with 14 of your top 20 public builders, and the long-term outlook continues to be strong and bullish with all of them. And so like with the jobs data and other things that we've seen, I think that the market is really in a wait and see mentality right now. You've got the market, pricing in Fed rate cuts, about 3 of them probably this year. Is it going to be 50 basis points or 25 at the next meeting? That is to be determined. But at the same time, your consumers out there are very fickle, and they're responding to this uncertainty. And why would I get into a mortgage today when there could be reductions in the future? So we remain very optimistic in terms of the outlook, not just for 2024, but for the next several years in the new home sector.
And I have to bring up, because you're talking about those rate expectations, when you do have swaps traders paring back those expectations, for instance, like in September, they're only expecting about 25 basis point cut there from the Federal Reserve. How measured of a approach? Because if it isn't as aggressive, what does that do for sentiment, and how long does it take for people to wait until they could potentially have better deals in the housing market?
Well, I think that, of course, that's going to have an impact, but we need to take a step back and look at, what is really fueling this sector today. And it's definitely new home building as compared to resale. We've talked about the lock-in effect before that we're seeing for anybody that's in existing homes, not wanting to get out of those low rate mortgages. But your builders are continuing to really push incentives. It increased in August to 64% of builders are still offering incentives, and 33% of builders offered price cuts month over month. And so they're really working to get these home buyers into homes in order to continue to drive their market share.
You said you're optimistic, home builders are optimistic, and it's not just this year, but next year. Why is that? Is that the expectation that the rate environment eases? What is it? Is it demand? What specifically?
Your underlying market fundamentals are not changing. We saw last year the largest population increase in the U.S. in history. Migration is at all-time highs, and you've got these younger generations, the millennials, a little bit later, but moving into household formation years, the largest population that we've seen, and they too need a place to live. And so, when we say we're bullish, it's because really where everybody seems to be pretty comfortable is around 5.5% for mortgage rates. And when you have your builders out there who are offering these incentives to get them locked in at those rates or lower, I think they're going to see strong performance. And where Walton focuses is in the land space. So we're not developers specifically. Sorry, what was that?
No. And go there, because it's one of the reasons we love talking with you. When we talk about home building, it's first of all, it's land acquisition, right? It's, what you have to deal with in local markets, and getting all, the approvals, if you will. So talk to us about where you've been buying and how much buying, and how we last, I think, talked with you back in April, like how that has shifted in the last few months, or how it compares.
We're still focusing on that southern smile of the United States, but continue to focus on those markets who are pro-growth, pro-development, and as I've talked to you about before, areas where we're confident we're going to be able to get approvals, and where they're going to have funds available to finance infrastructure. Texas, Florida, so many states really have great programs in place. And your builders continue to drive land banking strategies, off-balance sheet financing strategies, so that they're putting their capital to use in the most effective manner. Their amount of contracts that are under option as compared to outright purchases are the exact inverse to where they were a year ago. 60-70% of deals under option, and they're sitting on a lot of cash. Horton has $3 billion in cash. Their investment grade rating just got upgraded to A minus because they have really strong internal fiscal policy.
I have to ask, since I am a millennial and I do have an apartment in Manhattan, but I do not own a home. So you were talking about that Southern smile in the South, but what about when it comes to those more expensive corners in the U.S. and what you're seeing there as far as the biggest obstacles, which obviously the obvious ones are the price points there?
Yeah. Well, we actually feel that this cooling that's currently happening is needed, not just so that the Fed actually responds and starts to bring rates down, but also we need home price appreciation to cool off a bit as well. My builder colleagues might not appreciate that comment, but we need to ensure that affordability gets in check. And so this current little pullback, and I do believe it is just a short pullback, is necessary to control that. The Northeast actually saw great numbers, not so much in the single family space, but multifamily is booming there, townhomes, condos. And so, that demand, as I said, continues to be there, and we're seeing some tempering, hopefully, in that pricing.